Good evening, all. I'm Epstein, and here we are with your Stock Spider ETF wrap-up. And this wrap-up is for Thursday, April 6, 2023. Well, the first thing to say is there'll be no trading in stocks, ETFs, and the like tomorrow on the exchanges. So you walk away from those, but you have the all-important jobs data report. How do you handle that? And what's with the government not seeing Good Friday, exchanges closed, move the report to Monday? Like the other things, okay? Some of this just, you have to wonder who's behind the wheel. I mean, does it make sense to you? If it does, terrific. You should be one of those guys working in Washington. I think to 99% of us traders, it makes no sense. So you're going to get a big report with just a few markets open. You have the stock index futures open. You have the currencies. You have the interest rates. That's it. You know there's going to be reactions all over the place, and will they soothe out or will they explode over the weekend when we reopen in the futures, the other markets Sunday night as things gradually come back in, and then, of course, first thing in the morning. You always have an aftermarket. I don't know which ones are open and not in the stocks and the like, but you do, and we'll take it from there. So that's what you're looking at. You know the battleground. It's going to be the naysayers that no matter what happens, no way the Fed can stay this year and keep that going. I wrote a whole report on it. I'm giving where the projections are coming in from groups of analysts, in fact, where they think the market will be back down at 4.25% by year end because the Fed will have to cave in. I don't see the Fed caving in unless the economy caves in. I'm the other school, okay? I learned the guy with the most money in the room typically wins. The Fed has endless money. If they break the system, they'll change. We saw the banking change. There's no question about that. And that gave pause to ideas there. I happen to think the other big shoe, and I write about it again tonight, is commercial real estate. I think that you're just waiting for a time bomb here to go off, and it's going to go off soon as loans mature. And you get these, what we call B and C grade buildings in big cities that are basically running without anywhere near full vacancy, probably operating at losses, and then they've got to go in for loans that are maturing and ask the banker to do that. The problem for the banker is, does he want to own that building? What's the value of the building if he goes to market to sell it in a bankruptcy? He's got to consider that. There's a lot of things. But do I think that's going to happen? I want to go on record. I do. And I think that it's the next shoe that drops, along with some banks still in trouble. So if you look at oil, I've been telling you as we popped up here on the day that OPEC made its announcement that we had a gap in the chart. Remember me saying that? And I said that, you know, one of the things that I've learned is charts, tea leaves, like to fill gaps. And here's a big gap in that chart, and that's at 49.53. Market starts on its way down. You get to a low of 49.96, 49.91, 49.50 today. Can you believe it happened? Oh, my gosh. I am the least surprised person on the planet about it, all right? That normally is what occurs. Now the game's interesting. So we look at the rest of the chart. You still have an uptrend until you take out here 48.62. The trend is up. The 18-day average is not in play. Why? To get there, you have to break the trend. What stopped the rally? The first hit of an average you hadn't hit in a while, the 100-day average and the Bollinger Band. So I keep telling you about Bollinger Bands. Another common pattern, by the way, very common, are outside days. You've got to learn to work with them. And once you do and you see the continuation pattern or non-continuation verification, you have another edge. Those are two big things that I look at on charts. So in looking at the market, if it wants to break back to support, it is 47.86, but then the market, what happens is you're out of the uptrend, you got to do more sideways action. What about the downside for Charles Schwab? Well, you just hit it yesterday. You got a little bounce. Is it going to embed and say we're going even lower or not? I don't know. I think the pros came out yesterday, and now they're just looking at it. But this is another shoe ready to drop. They're not down here and not bouncing for a reason. Before SVB Bank, this market was sitting at 80. It's almost cut itself in half. It has to do with exposure that they have in some of these longer term instruments if they're forced to cash them in and take a hit to their capital. I'm not saying they're not well capitalized. I'm saying the market is anticipating a problem. In the gasoline fund, come on, we put out, 3 weeks ago here? And I was saying, look for the spring, summer rise in gasoline. You have an embedded reading. You want to come in my opinion, on the break. Where? Become a subscriber in the morning and see what I say. Tesla, okay. Tesla's now got a higher high and a lower and low pattern. What the market just doesn't like is these price cuts that they had to do hurts the bottom line. It loves that the manufacturing numbers are up, but they're making less per car, and they might want to continue doing that. There's nothing better than hurting your competition in a way that keeps them from expanding, and maybe they get hurt. The problem is that only works so long. You know why? All your competition, all of them are going to have electric cars. So you're prolonging it, you're not changing anything. What are you doing with the time frame you're prolonging is what I want to know. And knowing Musk, he'll find something clever to do with it, I'm sure of that. In XLF, look at how narrow the Bollinger Band got again. Now, we went here before. We've done this, and then the market resolves itself one way or the other. We'll break out of that. But this big period where we had the break to the downside in the financial services, we've repriced this market. And it's not ready to go to the upside. It could have another leg to the downside. You got to be careful. What do you think would happen in XLF if we have another bank failure? Bank warning comes out, probably the downside. In the industrial sector, it's hard for industry to be up with high interest rates, a Fed that wants to attack this at one time, wants to hurt employment, which means take money out of people's pockets. That is the goal right now, to quail the inflation. That's what you want to do. You want to pull back on it. You don't want that person just spending, I can get anything. I'm getting this. The reports are still out, though. If you look at the joblessness and people that get jobs, those that are still quitting jobs and getting new ones are on average making more money by way more than on average, by the way, making more money than the job they just left. So as long as that goes on, people, that's why people think this recession will be one that is not a deep recession. In stocks, we saw the semiconductors let go, including NVIDIA. They all did this. Now in the home builders, we have pulled back from a lower band to an upper band to a lower band. I want no part of the short position or the long position. I don't know how to trade in that thin, narrow band. How many times do you hear me say that to you right here? You get these thin bands, you walk away because it's a meat grinder. I've been there. I have done it. I have been ground up, spit out, name what it is. So have you. Learn to recognize that. In energy, you've gotten into a real problem area. It's the first hit of a 100-day average and a Bollinger Band together, and you're not embedded. So the market's grinding through this. Wouldn't surprise me if we get some pullbacks. You saw what happened in Schlumberger already. In GLD, you came up here, went to the Bollinger Band top, pulled back. Now, you could embed. How close are we? Both numbers were over 80 today. Yesterday, both numbers were over 80. And the day before, not the day before, you embedded. Now, what do I teach you? If you close in the lower part of the market and you're barely embedded, if the market opens steady to lower the next day, and it's not going to be tomorrow, obviously, you lose the embedded reading and you might be headed back to the 18-day average. Do I have any idea, because of this craziness of releasing the jobs report on a Good Friday when most things are closed, what's going to happen when the market reopens? I truly don't, but we'll have to see. In SLV, you have the fully embedded reading. So breaks in this market, unlike gold, this market can afford a drop. Gold cannot. Still going to stay in the bull camp until that embedded reading is lost. In the copper market, you got your embedded reading. This is acting better and better until the red line closes under 79. Out you go. So let's check and make sure it's embedded. Day one was today. Yesterday, certainly both numbers over 80 the day before. Day before, you've kept it. Are you going to lose it? Well, that remains to be seen. But until it's lost, it ain't lost. And that tells me I'm looking at the market as a potential buy. You know the rules. I always let the first half hour of trade go by when the market does open. Then I look at it. People ask me all the time, why do I do that? Futures trade 23 hours a day. They're able to have a market where they close at 4 o'clock, reopen at 5 in the vast majority of them, not all. Some open a little later in the evening, those that are the soft commodities even later in the evening. But the vast majority are 23 hours a day. And because of that, you don't get bumps in the road to get hurt. You always have a bump in the road in the stock market. It closes at 3 o'clock, right? And then it opens, and I'm talking, it closes at 3 Central Time. I'm using where I live, Central, and it opens at 8:30 Central. In between that, a lot goes on. I let the algorithms who have traded in the off-exchange markets match their prices with when the market opens up. That's them at work, and then I like to come in. That's my theory. You don't have to agree with it, but I believe in it. TLT, up to the upper Bollinger Band, just grinding out, but it hasn't embedded. Caution. I think the pros came out there. I am bearish on the dollar until you lose the embedded reading, but I don't know what the jobs data is going to do. And I'm bullish on the FXE until I see the jobs data and the impact of that. So you put it all together. You have your ammunition. I'm going to be here, by the way, on the weekend doing your recording for you. There is no tomorrow morning Spider ETF subscriber video since I got nothing to talk about. The markets won't be open. But I will over the weekend be putting that out. And if you haven't taken my Outside Days course and you've taken the Bollinger Band, you want to take this. It's the other tool that gives you an edge in the market. Why? Because you get this pattern so often and people typically don't know what it means. You get it and you're going, well, what's that? It's typically a continuation pattern. I create 9 video chapters. I'm not going to bury you in teaching you. You're going to get this right away. I'm going to instill it. You're going to get our charting software. You see it. Yours will be identical, by the way. You see what I do. You do the same. And then I'm going to give you 2 weeks free to all my research if you qualify for that, which means you're not a paid subscriber right now. And you're going to get that to go with this, and away you go. And I try to instill in you, here's that pattern. What do we do? Here's what happens here and there. And you see it unfold in real time. All right. How do you get there? It's simple. You can either call my staff. You can go to our website, iraepstein.com. You can move your cursor up to the top here. There will be an icon. On that icon, give it a click. It'll take you right there, and learn. The best thing you can do for yourself is invest in you. That's the best thing you can do. I'm Ira Epstein. You have a good day.